Today on Forbes, why stablecoin issuers could displace Japan and China as the biggest buyers of U.S. Treasury securities. Brian Moynihan, the chief executive officer of $2.6 trillion in assets Bank of America, doesn't usually make headlines for his crypto opinions. But in February, he did just that. He said, quote, "If they make that legal, we'll go into that business." He was talking about stablecoins, blockchain-based tokens typically pegged to the US dollar, and increasingly, the plumbing of global payments. The they he was referring to is Congress, which is now racing to lay down the rules of the road for these crypto creations. The Stable Act in the House and the Genius Act in the Senate are dueling bills with a common goal: to bring stablecoin issuers into the regulatory fold, spelling out exactly how much capital, liquidity, and risk management is enough. They also aim to clarify which federal or state agencies get to play referee. But there's another, less flashy subplot. How will widespread acceptance of stablecoins among traditional institutions globally affect the $28 trillion United States Treasury market? Treasuries are the backbone of stablecoin reserves because not much else comes close in terms of safety and liquidity. If you're offering a digital dollar, you need to back it with assets that are as close to risk-free as possible. This sounds a lot like hundreds of money market mutual funds, which are issued by giants like BlackRock, Fidelity, and Vanguard, and hold over $6 trillion in assets, mostly in U.S. Treasury bills. The big difference is that unlike a money market fund, say from Fidelity, which might pay you an annual yield of 4%, most stablecoin issuers have so far resisted offering any kind of yield or income to their holders. That's one reason why Tether, the largest of them, has extremely high margins and reported over $1 billion in operating profit in the first quarter of 2025. Right now, the dozens of stablecoin issuers that exist, though mostly Tether, based in El Salvador, and Circle, headquartered in New York, hold an estimated $150 billion in U.S. government debt, primarily short-term T-bills. That's a rounding error in the $28 trillion Treasury securities market and a fairly insignificant portion of the $6 trillion in Treasury bills outstanding. Most Treasuries are still held by the U.S. government itself. Think Social Security and federal pension funds. U.S. mutual funds, banks, and insurance companies are the next biggest holders, with foreign investors accounting for about 30%, roughly $8.8 trillion, led by Japan and China. But Britain's Standard Chartered Bank, an $874 billion in assets institution that offers custody for cryptocurrencies, projects that the global stablecoin market could jump from $240 billion to $2 trillion in just 3 years. Both current drafts of the stablecoin bills in Congress explicitly identify Treasury securities with maturities of 93 days or less as one of the few acceptable reserves. That could mean an extra $1 trillion in demand for T-bills in the near term, according to an April 30th presentation by the Treasury Borrowing Advisory Committee, a group of senior bankers, asset managers, and hedge fund representatives that advises Treasury officials each quarter. Citi's research team goes further, suggesting that by 2030, stablecoin issuers could surpass any single foreign country as holders of U.S. government debt. Treasury creditors like China and Saudi Arabia are quietly trimming their holdings. Enter crypto users around the world, in places like Buenos Aires and Nairobi, using stablecoins for everything from paying their rent to hedging against local currency volatility, and simultaneously stepping up as a new eager class of lenders to Uncle Sam. The Trump administration has already made its stance on stablecoins clear. Crypto and AI czar David Sachs has argued that they could help secure the dollar's global dominance, and President Trump has pressed Congress to get a bill to his desk before the August recess. Meanwhile, the Trump family's crypto venture, World Liberty Financial, announced plans for its own stablecoin, which is now apparently complicating the fate of pending regulation. For full coverage, check out Nina Bambasheva's piece on Forbes.com. This is Kieran Meadows from Forbes. Thanks for tuning in.